We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome to Palisades Gold Radio. I'm your host, Tom Wojcicki. Joining me today is Steve Thomas. He's the author of the Gold Mining Bull portfolio on Seeking Alpha. How are you today, Steve?
Hey, I'm doing good. How are you?
Excellent. Excellent to have you back. And let's start by having you give us an update. What has really happened in the gold market since the last time we spoke?
Yeah, it's been a crazy couple of months. You know, we saw gold essentially after gold hit 2,100 an ounce. It's been just like a slow decline, but I think we've hit a bottom here. I mean, clearly the last couple of weeks, the sentiment in gold and gold miners was the lowest that it's been all year. About the same time that Bitcoin hit 20,000 when gold was at 1770. I think that could be the bottom in gold. So just a lot of fear on social media, seeing a lot of people saying that, you know, Bitcoin's replacing gold, a lot of negative sentiment. And I like seeing stuff like that because it's a buying opportunity. So the past month or so, I was buying gold stocks heavily at 1770, 1780 an ounce. It kind of reminds me back in 2009 when we saw gold fall to, it was about $700. After it peaked at 1,000 and just really, really negative sentiment. And so, yeah, so if you're bullish on gold and you have really strong conviction, you should be buying, definitely. I think more likely than not, we've seen the worst of it at this point.
So let's talk a little bit about how you and I were speaking about how when gold fell below the 200-day moving average, it has not stayed there for long, and how you identified this bottom, as you called it.
Good question. So back in March, we saw a really nasty correction in gold, as well as stocks and everything else sold off. But that was the last time gold slipped below its 200-day moving average, and it shot right back up back in March. So that was a V-shaped rally. Now we saw gold briefly go under its 200-day moving average, and that's when it hit a lower of about 1760 an ounce, and it did not stay there. So it's right back up above the 200-day moving average. Once you hit a level that low, buyers step back in, step back up to the plate and start buying. It's bargain buying, essentially. I think people realize that, gold was a good buy. And so the other thing that happened once it dipped below the 200-day moving average, it hit oversold levels on the relative strength index. So that's a technical indicator that just shows you when gold is overbought or oversold. And it reached the lowest point this year, except dating back to March. That was the only other time that gold has been truly oversold. So absolutely, it was a buying opportunity. And, after it hit below the 200-day moving average, it popped right back up. The other thing I look at was the MACD. The crossover occurred recently. So essentially when that happens, it's a very bullish sign. It shows you that the momentum is back in gold's favor. And yeah, so technically, it's looking really good for gold here.
One of the other technicals you use is the CCI. So can you tell us a bit more about that too?
Yeah, it's just similar to the relative strength index. It's just another way of measuring whether an asset or a stock is overbought or oversold. And just like the relative strength index, the price of gold was really, really oversold. Does it make sense for us to pull up a chart really quick?
Sure.
Okay. The important parts here. So if you look back in March when we had that V-shaped rally, you'll see the MACD. Oh, wait, let me start with the relative strength index. We were right at the bottom there. So right near oversold levels. And then on the commodity channel index, it hit oversold. So under -100 is oversold. So that indicates that gold was extremely oversold back in the middle of March, as were many things at the time. But the other part here, you'll see that we were overbought in August. That's when gold seemed like everyone was bullish on gold at the time. I was seeing a lot of euphoria. We were really overbought. So that would have been a good time to lock in some profits. But since we peaked there, it's been kind of like a slow bleed, slow decline. And then this last big drop here before December, so middle of November, we took that steep drop down below the 200-day moving average. So we hit about 1760 an ounce, and that's the most oversold that we've been. So on the relative strength index dating back to March. So that's the second most oversold we've been. So you'll see, obviously, it did not stay there long. It popped right back up. So I think more likely than not, we have seen the bottom. A lot of positive things I'm seeing here. So the MACD, you'll see we had that crossover that's bullish.
Mm-hmm. So again, that just helps us identify a bottom and possibly a buying opportunity. Let's talk a little bit about the seasonality to the December tax loss selling that we actually typically see this time of year.
Yeah. So in particular, in certain gold stocks, if you have losses on a stock, people will take the opportunity to take the losses in December going into the new year. So it offsets your gains. So December, it's tax loss selling. It's common for the gold equities. Now for gold, physical gold in general, December is just not a really good time. Seasonally, it has not performed as good as other months. Mm-hmm. So knowing that December is a good time to load up on gold stocks. Every year when I put out my top gold stock picks for the following year, I do like putting this out in December because this is when the stocks are typically the best price. Mm-hmm. And it's just the best time to buy typically. Yeah, so it is a good time to buy. It's not a good time price-wise for gold and for gold stocks typically, but it is typically a good time to buy.
Mm-hmm. So let's talk a little bit about something that you and I were speaking about before the call, and that's the supply and demand for gold from the jewelry and the central bank, actual physical demand this year, and how historically, when the central banks end up being net sellers, what happens after the last time, let's say, that happened?
Okay, so it's a very interesting year because even with gold up, I want to say gold is up 20% this year, believe it or not. So even after all of this negativity the past couple of months, gold is dying, Bitcoin is the new gold, blah, blah, blah. Gold is having a really, really good year. And it's doing that with really, really low jewelry demand. So I pulled up the numbers. And of course, gold's demand does not come solely from retail investors, meaning people who are buying the GLD. That's one part of it. And it's a big part, but it's not the only demand that we get from gold. We get central banks and jewelry are two very important drivers of the gold price. And what's interesting, like I was saying, is that central bank purchases are down 30% compared to last year. They were actually net sellers for the first time in 10 years. So that was in Q2 of this year. So that obviously had to do with COVID, right? So that's not normal. I mean, they've been adding gold to their reserves every quarter for 10 years. The other part of it is getting back to jewelry demand. Jewelry demand was down 40% from last year. So clearly with coronavirus, people aren't out buying golden necklaces or bracelets or anything like that. So having said that, I am optimistic that we're going to have a really good 2021 because we're going to see an uptick in those two segments of gold demand. Central banks should come back to the market and start adding to their reserves again. And I think jewelry demand will be strong, assuming that this virus is under control and at some point, we get back to normal.
So as you mentioned, GDX and GDXJ, you were sharing with me that they're not necessarily the best way to invest in miners. Why would that be? And what would a better strategy be instead of buying into those ETFs?
So the important thing to know about the GDX and the GDXJ, so this is an ETF that contains a basket of mining stocks, right? The first thing to know is it contains certain stocks. There are certain requirements to get included into these indexes. You have to be a large company to be in the GDX. So it's only going to include those types of stocks. You're not going to get the opportunities that I seek out. I look for, besides the producers, which are well known and included in those indexes, I look for juniors, companies that are less known by the general market, that have a lot of upside, that are maybe ground floor opportunities. So they're not really heard of yet, but they're not household names yet, but they're on their way to getting there. The GDXJ is the Junior Miners Index. It does not have any true juniors in the index. If you look at the actual holdings of the GDXJ, it doesn't have the types of stocks that I look for. So I want to buy juniors, true juniors. So the way I define that is sub $500 million market cap. So these are smaller companies, and you're not going to really find them in the GDXJ. So that is one really important thing to know, that when you're buying those indexes, you're only getting exposure to a certain type of company, the larger miners. The second thing is they do carry expense ratios, and they actually are pretty high. I haven't looked recently, but I know they're over 0.5%. So that is an expense you have to pay. And the other thing I don't like about them is, well, first I should start with, you can outperform them easily, in my opinion, if you select your own stocks. That's exactly what I do. That's kind of the whole point of my service, is I'm trying to outperform the basic indexes that track gold miners. So if you're very careful about which stocks you choose, you can do that. And so that's what I've been doing, and I've been outperforming. The other part of it is, you don't truly get the benefit of owning a gold stock in a takeover if a takeover happens. So if you own a stock that gets taken over at a premium, you get the benefit of that by owning it. Obviously, you get either the premiums in cash or, let's say, in shares of a new company. If that same stock was in the GDX or the GDXJ, it would kind of get lost in the whole index. So you don't get that direct exposure to the company that gets taken over. So I've had several stocks that have gotten taken over at 30%, 40% premiums and directly benefited from that takeover. And had I instead put that money in an ETF, I would not have experienced that. Does that make sense? Yeah. So I guess there's a lot to it. So you can outperform them easily, in my opinion, by buying quality companies. You can avoid the expense ratios, and you can benefit from owning the actual companies and getting, dividends, benefiting from share buybacks, and benefiting from takeovers directly.
So as you're talking about takeovers, what are some of your M&A targets for next year, and what is the potential you think that is coming into this space for these takeovers?
So that's a great question. The last time we spoke, I did mention that I think M&A is going to pick up. And since we spoke, a number of deals have happened. Notably, Endeavor is taking over Teranga Gold. So that's a big one. But I think it probably would have been a really active year for M&A if not for COVID. So COVID really slowed things down because, part of it when you're buying a company or merging, you have to do due diligence, you have to do site visits, and that just hasn't been possible for a while. So like I mentioned last time, I think this sector is really ripe for consolidation. There are just too many companies, especially the smaller companies. There are hundreds and hundreds of companies in this sector, and there are a lot of opportunities in that. So I think there's opportunities for smaller companies to merge with other smaller companies to get bigger. The purpose of achieving a higher market cap, but also a higher trading multiple, you would get higher trading liquidity. You could potentially get included into ETFs or indexes like the GDX, which would help your stock. You would get greater access to capital, lower cost of capital, more funds to spend on exploration, more ability to return cash to shareholders via dividends, the ability to reduce G&A expenses, and maybe the biggest benefit, combining operations. If you have two projects that are close together, there could be an opportunity to combine them to save money. I think Barrick and Newmont was a good example. They did a joint venture on the Nevada projects, and I think they've done really well with that. So there's a lot of benefits to M&A in the sector. And I think, just using a couple examples, Barrick Gold has done really well with M&A. Endeavor Mining has done really well. Equinox Gold has crushed it. They've been a huge success. They did a takeover of Leagold Mining, and they've done more M&A, and they've grown into a $2 billion company. So it's going to be good for the sector. I'm expecting a lot of it. And yeah, there's a ton of potential here for people to make money.
So another, let's say, tool that we can use to kind of inform what the buying opportunities are and what the insiders are doing in this space is, as you say, the insider buying report. So can you tell us a bit about what you've seen from that and where you would find that information?
Yeah, great question. So I've been tracking insider trading for years now. So just a note, so this refers to when management insiders, such as board of directors, when they buy shares of the company stock in the public, it's worth tracking. It's similarly, insider ownership is important. You want insiders to have skin in the game, that they're not, they're putting their money where their mouth is, essentially. So after you like a company, you've done the research, it all works out for you. Then if you track insider trading, it's very useful, in my opinion, because insiders typically are good timers of the market. I've noticed that typically, not always, but typically when they buy, it's at a good time. So they're buying at either a bottom or close to a bottom, and they're very smart about it. So I've probably been tracking insider trading for about 10 years now. So generally speaking, most of the time, I have found that they are good at timing the market. It's not the only thing worth tracking. Mm-hmm. It's kind of just like icing on the cake. If you already know you like a company, its management team, and you're interested in buying the stock, if you're also seeing that they're buying the stock, it's a good sign. So I put out an article recently on Seeking Alpha, and I said, look, here are 3 companies that have seen insider buying recently. Barrick Gold was one of them. Insiders were buying the stock heavily. So 4 or 5 insiders were buying shares of Barrick at $22 or $23 a share on the US exchange. And that might have been the bottom in Barrick Gold stock. Since then, the stock is up to $24 or $25 a share. So they were buying a couple of weeks ago. That was at the same time where gold was at $17.70 an ounce. So yeah, I think they were buying at a good time. I already liked Barrick Gold. I do own the stock, and I was also buying with them. So it did increase my confidence in making those purchases. So insiders buy typically for one reason. They think the stock is going to go up. Insiders sell for many reasons. There's no really saying why. Maybe they're locking in profits. Maybe they need the money for some reason, Mm-hmm. So it's not as big of a deal when you see selling, as long as it's not heavy, constant selling by multiple insiders. If you see sellers like selling 10%, 20% of their entire position, that could be a warning sign. Otherwise, it's not that big of a deal. Like, I'm not going to penalize a company because the CEO sold 1% of his stock. Like if a guy has 5 million shares of stock and he sells 100,000 shares, that's not a big deal. Mm-hmm. So I hope that makes sense.
Mm-hmm. So Steve, let's move on a little bit to talking about how you decide when you're going to say take profits in a position and or basically cut your losses if you're down.
Yeah. So I try to be patient, and typically when I really like a company and I've laid out a really strong investment thesis, if the stock sells off, I'll add to my position. I'll dollar cost average. But sometimes you have to cut your losses. So if something has changed with the story, whether it's a management change or drill results that come out that aren't that great, or if the stock just isn't moving based on drill results or based on a catalyst that I had expected it to break out on, that's a warning sign. Maybe a technical report is released that's just not that great. Maybe they make an acquisition and I don't like the acquisition and it doesn't fit my criteria. Maybe they're taking too many risks. So I guess what I'm saying is a stock going down in price isn't enough for me. I'm always reevaluating positions. I want to know that I'm using my money the right way. There's plenty of opportunities in the sector. But if something changes, that's when I would cut my losses.
Perfect. You were talking about wanting to release a couple of your picks on the show today. So why don't you share those with us?
Yeah, I'd be happy to. So full disclosure, I own these 3 stocks that I'm about to mention. So I'm going to name a producer, I'm going to name a developer, and I'm going to name an explorer. Okay. So this is 3 of 10 of my top picks. I'm going to release all 10 to my subscribers at Seeking Alpha. And also know that I have over 40 positions currently. So just to keep this in mind, but these are 3 of my top picks. So out of the producers, I really like Kirkland Lake Gold. I've owned the stock since 2017. So I own it at a low cost basis, but it's still a really good opportunity in my opinion. The company is really, really profitable, and their balance sheet is getting probably the best balance sheet in the entire gold mining sector. So here are the numbers. So I'll just throw out the numbers and I'll talk a little bit more about the metrics. So as of writing, their market cap's about 11 billion. They're going to end the year with over $1 billion in cash, and they have zero debt. So their enterprise value, what the company's truly worth, is about 10.3, 10.4 billion. They are insanely profitable with gold at its current price. They're profitable with gold at $1,300 an ounce. They're profitable even at $1,000 an ounce. They would still be making some money. But as it stands here today at $1,850 an ounce gold, they are one of the most profitable gold miners on the planet. Year to date, they produced $900 million in operating cash flow, $500 million in free cash flow. They are producing over $1 billion in free cash flow per year at current gold prices. So I guess most importantly, the stock is cheap as well. They trade at about 10 times their free cash flow. Their forward price to earning ratio is 13.5. And another metric to look at is EV to EBITDA. So you divide the enterprise value by earnings before interest, taxes, deductions, whatever. And it's about 7x. So the numbers here look really good. It's trading low. The stock yields 1.25%. The company's buying back shares. I think they realize that it's a really good opportunity for them to reduce their share count here. The stock is really cheap, so they are buying back shares aggressively. I think, it's just a really smart company. They have 3 really strong, profitable gold mines, 2 in Canada, 1 in Australia. So the jurisdiction risk is really low. I want to also add that they're being really smart with their money. So they have no debt. They have about $1 billion in cash, right? They could go out and buy a bunch of companies here. They could, go on a spending binge, but they're being smart with their money because I don't think it's a buyer's market right now. Instead, they're entering into these exploration agreements, such recent example with Wallbridge Mining. So they can earn into a 75% interest in Wallbridge's Detour East property. And they can do that by spending $35 million in exploration expenses over a 5-year period. So they don't actually have to put any money down to do this. They can test it out. And if they're not getting good results, they can stop at any time. So this is a really good move for them because Detour East is 11 kilometers east of the Detour Lake gold mine. So that's one of their main assets. It's a foot in the door there. Maybe they'll find something really good. Maybe they won't. But it's super low risk for them. So I think we're going to continue to see them finding these joint venture agreements on exploration properties. They might also be a buyer of assets, producing gold mines or near-term development assets in 2021. But regardless, I think it's just a really smart stock to own here. I think the knock on them is Fosterville, their mine in Australia. It currently has a 4-year mine life remaining. So they have about 2 million ounces of gold reserves at the mine. And they're producing over 500,000 ounces of gold per year from it. So they need to aggressively explore the mine and find more reserves to extend the mine life. Because I think the concern is that what happens after the 4 years are up, then their best asset's gone. But personally, I think betting against them finding more gold at this point is foolish. They've had so much success at that mine with exploration that I think they're going to extend it to at least 5 or 6 years. It only has a 4-year mine life because it's producing so much gold. Mm-hmm. Kirkland Lake Gold is the way to go.
Great, Steve. So let's move on to the developer you have in mind here.
Okay, so just a note on developers, they're not producers. They don't produce cash flow from operations. So there's more risk here. They're trying to build a gold mine. So just know that. So quickly, my philosophy on developers, I don't like chasing massive deposits. We talked last time about the 30 million ounce gold projects in Alaska. Avoid them. I like smart, not tiny, but middle-sized gold mines that are low capex. You can get them to production with relatively low capital and profitable gold mines. So that's the type of developers that I focus on. Clear path to production, low permitting risk. So having said that, I really like Core Mining. That's Kore Mining. They have 2 projects in the US that I think both of them have a really good shot of becoming gold mines, especially Imperial, their Imperial mine, their Imperial project in California. It's a simple open pit heap leach project. So the economics on that one look really strong. They put out a PEA study. It's a great starting point for them. This project is interesting because it's only 9 miles away from Equinox Gold's Mesquite mine in California. So Equinox Gold is producing gold very close to Core Mining's Imperial project. So that is just one of their assets, though. That is a really good asset. I'd probably buy the stock just for that project, but they also have the Long Valley project in California. It's another open pit heap leach project. So these are simple, low cost types of mines, low capex, easy to get to production, relatively easy. This is not underground, narrow vein gold mining. It's not complicated. So I like open pit mines. And just a note, so Imperial's price tag, 143 million in upfront capex to get to production based on the technical report they put out. And it is expected to produce close to 150,000 ounces of gold a year. Long Valley, their other project, it's not as good, in my opinion, as a project, but it's still got a really good shot at getting to production. The upfront capex on that one is 161 million to produce 102,000 ounces of gold per year. So using a $1,600 gold price, the net present value of both of these projects combined is about $750 million. That's based on the technical reports. Core's market cap, this is as of Monday this week, it was 120 million. So it's trading at a very low multiple of its net asset value. So those are the projects. And then finally, the icing on the cake here is Core also owns some promising exploration properties in Caribou in British Columbia. So this is going to be a really hot district in 2021, in my opinion. Osisko Development Corp is planning to drill like crazy there at their Caribou mine. So this was the Barkerville Gold Mines project that Osisko bought. And then Osisko spun out the project into a new company, Osisko Development Corp. So Osisko Development Corp is going to be drilling like crazy in this region. Core has some promising exploration ground south of Osisko's Caribou mine. So it's really not that far off, and early results have been very promising. They've hit some high grades there. Core's plan is to spin off the exploration assets in British Columbia into a new company, which shareholders of Core would get shares in that new company. So I think that's a good opportunity. You know, you're buying Core stock here if you like. They're two projects they're both in California. You're buying it for those projects, but then you're also getting shares in a new company. Should that go through in early 2021, you'll have some really exciting, potentially high-grade drill results coming out of those properties next year. So it's a good pick. I really like their chances. Most importantly, I like the management team. I spoke to the CEO recently. I think he really knows what he's doing. He previously was with Nevsun Resources, a company whose stock I owned. They got taken over by the Chinese company, Xinjiang Mining. So they're a really smart team. Management owns 38% of Core Mining. That's really important for me. I want to see insiders that have skin in the game. Core has it. On top of that, Eric Sprott owns 26% of the company. Okay, so Sprott's a smart guy. It's great to see someone like Sprott heavily invested in this company. On a dollar basis, this is a very large position for him compared to his other positions. If you follow Sprott, you know that he invests in a ton of companies in the sector. But on a dollar basis, I think this is one of his larger investments. So quickly, just the knock on Core. Their two projects are in California. The permitting risk is higher than in other parts of the US, such as Nevada. So it's a little bit trickier to get a mine built. But having said that, Equinox Gold has now permitted and built and is operating two mines in California. So that would be the Mesquite mine and the Castle Mountain mine. So it's a riskier jurisdiction technically, but it's possible to produce gold in California. So I think the risks are a little overblown there. So I really like Core. I feel strongly about them.
Awesome, Steve. So tell us about your Explorer pick that you still have.
Yeah, so this one is very interesting. So with Explorers, it's all about location, right? And this pick, they've got a property that is in a great location. So Labrador Gold Corp is my pick. Their Kingsway project is located very close to Newfound Gold's Queensway project in central Newfoundland. As many of us know by now, Newfound Gold has been hitting some really, really strong results on their property. And some of those results, of course, 19 meters of 93 grams per ton gold, 22 meters of 41 grams per ton gold, very high grade near surface drills. Kingsway Labrador Gold project is 2.5 kilometers northeast on the same trend as Newfound Gold property. So it's 1.5 miles from these discoveries that are being made at Newfound Gold. It's early stage. Of course, we don't know if they haven't drilled yet. So we don't know what they're going to find, but everything that I've seen to date, all of the prospecting work that they've done has returned very high grade results. So they are one to watch for sure. I think with what I'm seeing with their results, I'm expecting some very high grade drills to come out of Labrador Gold. They're very well funded. They've got about 12 million in the bank right now, and their market cap's about 48 million. So they're small, but I think that's part of the opportunity here. This is a ground floor opportunity. Newfound Gold is well known right now. Newfound Gold's market cap's over 400 million. Labrador Gold's an opportunity to get into a company that is just starting out. I think this could be a triple. I think it could be, I don't want to say too much about potential upside, but there is tremendous exploration upside here. So I'm really excited about Labrador Gold.
So as we wrap up here, Steve, share with us some things that you're looking forward to for, let's say, the gold price and any developments going into 2021 here.
So what I think investors should keep an eye on and what I would like to see is a rebound in central bank demand and jewelry demand. So assuming, this vaccine for COVID is going to be rolled out and then it's successful, things go back to normal, I would expect demand for jewelry to go back to normal levels. Remember, it was down 40% year over year. Central bank demand was down similar from the prior year. Central banks were selling for the first time in 10 years. I expect that to do a complete 360, and I expect the demand for jewelry and central bank to go back to normal. And that should be a driver of the price, in addition to people buying the GLD, people buying coins and bars and all that. I think it's going to be a really good year for gold. Personally, I never get too caught up in predictions. I'm not the type of person who says, I think gold's going to $10,000 an ounce. I think we're going to see gold go up about 10% per year. And I say that because it's been doing that every year since 2000. So on average, gold has gone up 10% every year since 2000 on average. That's kind of my base case, what I'm expecting from the price going forward. Of course, we'll probably go up more than that, but at a minimum, 10% feels like a strong possibility. So that would take us over $3,000 an ounce in 5 years. So it's going to be a great year. I think 2021 will be a great year for gold.
And as we know, the miners provide great leverage to really stretch out and exercise better profits from the profitability of gold at these prices, right?
Yeah. So the miners provide about 3 times leverage. I'd say 2 to 4 times leverage is what I've seen. So for every 10% increase in gold prices, the miners should go up 20 to 40%. And the developers and the explorers should go up even more. They're even more leveraged to gold. So that is what I'm expecting. I'm expecting miners to certainly catch up to the gold price because miners continue to trade at really, really low valuations relative to the price of gold compared to other sectors. Gold miners are just stupid cheap here. And I think it's going to take probably a couple more quarters for investors to realize it. Once we see more earnings reports coming out, more dividend raises, a lot of these miners are paying dividends now. The stocks are yielding 1%, 2%. We're going to continue seeing dividends. And, I'm patient. I can wait. I know some people don't like to wait, but I think it's going to play out maybe over the next 2 or 3 quarters. We'll start to see the miners really take off.
Excellent, Steve. Point us to where we can find more about your letter and where you put out your information, such as Twitter. You're at Gold Mining Bull, right?
Yeah, Gold Mining Bull. So on Seeking Alpha, if you create a free account, you can check out my service. I write under the name Gold Mining Bull. So you can check me out on Seeking Alpha. I'm on Twitter. And my subscription, if you sign up for an annual pass, Seeking Alpha does provide a money-back guarantee for 30 days. So people should know that. You can sign up for an annual pass, and then if you cancel within 30 days, they do provide that guarantee for you. But yeah, I appreciate it. I'm really bullish on gold. I'm going to continue investing in this sector. And I know I'm making people money and my subscribers are very happy. And so I'm just blessed and looking forward to another profitable year.
Excellent, Steve. Well, we'll look forward to having you back in 2021 for another update here. Thanks for your time today, Steve.
Thank you. Have a great new year.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.